You might be surprised to learn that according to a recent research study featured in Forbes, Americans lack basic and yet important knowledge about retirement planning. In fact, participants in this study were asked to take a simple test about retirement, and get this, 80% of them failed. What's even more troubling is that nearly all of the participants believed that they were very knowledgeable or somewhat knowledgeable about saving for a comfortable retirement. Is it possible that you could be overconfident and not be prepared for your retirement? Let's make sure you're prepared. It all starts with a free, customized B.O.S.S retirement blueprint. This process could save you tens of thousands, if not hundreds of thousands of dollars in just taxes in retirement. Discover strategies for wringing every nickel out of your Social Security benefits, plus so much more. It's easy to get started with our free B.O.S.S retirement blueprint. Just check out the description on this episode where it says, get your free B.O.S.S retirement blueprint. You can call the number at 800-769-7550, or click a link to connect with a member of our team. It's right there in the description. A text, a call, or a click is all it takes to get started with your free B.O.S.S retirement blueprint. Hello, everyone, and thanks so much for joining us today. Man, we have a great show for you today. We are excited to have Jeremy Green. You know, oftentimes it's just Tyson and I. You hear the Retirement Brothers talking on the radio, or you see us on television, but you oftentimes don't get a sneak peek into the back office of what helps us be so successful at B.O.S.S Retirement Solutions and Advisors. And so, you know, as we were sitting there talking about that, we're like, hey, why don't we bring in some of the team today? And why don't we bring in those experts that really help us to make a difference in the lives of all of you? And so today we have a special guest. We have Jeremy Green, who is on our team of advisors. We're so excited. Jeremy, welcome to the show. I'm going to give you a formal intro here, but how are you doing today?
I'm well. Thanks. Thanks for having me.
Oh, we're so excited to have you. And, you know, Jeremy focuses on high net worth, tax situations, estate and business planning. Jeremy has 22 years of experience. So this is not Jeremy's first rodeo. He works with many professional advisors around the country with what are the cutting edge and unique strategies to help those closely held businesses and also clients with significant assets. Maybe they have highly appreciated stock that they're not sure what to do. Maybe you've worked for the same company for a really long time. And then you combine this whole piece together of charitable contributions and how do you make this all fit together with your your tax planning, your income, your investments, your life insurance, and all these different pieces. And, you know, one thing that we love about Jeremy is he is a military veteran, and we always love working with those who proudly served our country. Jeremy was in the U.S. Army, the 2nd Infantry Division, stationed in Korea from 1996 to 1998. And if you ever want to have a great conversation about how to minimize tax, how to take care of your estate plan, how to make sure that these complex issues that you may be thinking about come into just real clear and simple focus, Jeremy Green is the person on our team that helps us with this, just like many of our other advisors that we have, tax attorneys and also CPAs. So Jeremy, welcome to the show today. And we're looking forward to diving in. And Tyson, let's hit these questions. Yeah, Jeremy, we love spending time with you. And we especially love those clients of ours who've got a couple $1 million to maybe up to $5-6 million to work with you alongside our advisors. Why does that work so well to work with our team? To be able to work with these individuals who fall into this category. Talk a little bit more about that.
Sure. Well, the great thing is a lot of these people that fit in that net worth, it's not about need at all. They don't necessarily need anything if you think about the strictest term of the word need, but they may want to integrate certain opportunities, like the ability to integrate their legal, financial, and tax planning matters and they're looking for clarification. So it's about opportunities, what opportunities they could capture. I think that's a more positive conversation than what you need to do, right? Anyway, so I actually enjoy it, and it's really about not having a particular direction, but letting them know the opportunities, and they'll gravitate to one or more of those, and then focusing on those.
I love it. You're exactly right that this becomes an opportunity to really get to know the client, to be able to understand what they are looking for, not necessarily what they need, as you mentioned. One of those opportunities right now that's pretty unique. We just in the news, there was a headline that said we have more uh, millionaires that have highly appreciated 401ks and IRAs than ever before. Let's talk a little bit about why that's a unique challenge to deal with, and maybe talk to people about what the opportunity looks like right now.
Well, for qualified assets, in 401ks, that's dollars that were taxed, they were deferred, not taxed at the time you put them away, and then will be taxed later on. A lot of times people think of Roth conversions. I think that's somewhat well known in the space, but there's a few other options that most people aren't aware of. And because of certain, tax law changes happen often that make new techniques available. So sometimes it's not just about what they thought they wanted to do, but things they come to us for to know what's even possible that they would want to do if they knew it existed, right? And so I think those are interesting conversations. But the if I had to summarize qualified dollars, it'd be this: you have Roth conversions, you kind of win or lose if the tax rates are higher in the future than they are today. If they're not, you can actually lose on that. So it's a maybe benefit with a certain liability, a check you have to write to the government to capture that potential. You have two other options. The other thing that's tax free is life insurance. Now, I don't care if you need it or not. That's not the question. The question is, what outcome would that produce if we looked at something like that with the same check we were going to write to the government, but instead created an asset, okay, instead of a liability. And a third one, and this one to me is a no-brainer for anybody with like a $1.5 to $2 million IRA or greater, with not too many beneficiaries. The reality is that you're subject to the 10-year non-spousal rules at the second spouse to die. So with the first spouse to die, you leave everything to the other spouse like you normally would. But the second spouse with the 10-year rules, basically you have to take the equivalent of RMDs for each of the next 10 years then, which means your beneficiaries get really high tax years for up to 10 years, right? Well, effectively, we could get a stretch of that for up to 20 years or even lifetime. Can even go lifetime plus 20 years, believe it or not, 2 generations. Most people, we're talking about 20 years, though. So simply going from 10 to 20 years, number one, we could double the size of the IRA with an extra decade. Potentially depends on rates of return, obviously. And secondarily, so here the tax savings as secondary matter, we may actually be able to drop the cost per thousand on tax rates, because if you had a $100,000 a year distribution, and you doubled the duration, you almost cut the payment in half, which is one of the ways we get to have more money compounding. So we may be able to drop them out of different tax rates effectively. So 3 options: Roth conversion, life insurance is the alternative. Again, not saying you should do that or need to, but what does that look like? And number 3 is an asset. And number 3, CRUTs, being able to double the duration and therefore have basically more money for your family and actually lower the cost per thousand on those dollars potentially.
I love that. On the qualified, I think the vast majority of Americans, that's where they've saved the bulk of their retirement savings: IRAs, 401ks, tax deferred retirement accounts, which, as we talk all the time on our radio shows and our public events and the television show, is, if you have, Ed Slott said, if you have an IRA, you have an IOU to Uncle Sam. And so that, those taxes and being able to mitigate those taxes is very important with tax planning. And so, time is of the essence. We always recommend that there's a lot to unpack. Just what you said, this is what we love about the simplicity in 3 simple solutions, but there's a lot of complexity that goes around those. So very, very important. Here's another one that we run into a lot is, let's say you've had someone work for the same company for their entire life, and they received stock. And so now we've got stock in a non-qualified account. So this is not inside the IRA or 401k. This is a non-qualified account. Now they've got this highly appreciated stock. What are your thoughts on how to approach highly appreciated stock if that were to be your situation?
Sure. So a lot of people have kind of won the game, I guess, if you want to call it that. At that point, let's say they're over age 50. They were at a company for quite a while, and to your point, they have an asset that's got a lot of gain into it.
Mm-hmm.
So they realize they're also sitting on somewhat, they're concentrated risk. So concentration is good if you're trying to get wealthy. Once you are wealthy, it could be problematic, right? So they will oftentimes want to diversify, and we would recommend that they consider that often. And they get that, but what holds them back is the tax implications of the realizing the gain, right? So there's never going to be a way to just wipe out the tax. So that the objective really is to reduce the tax mostly. And there are ways to do that, basically be able to diversify today, recognize the tax in the future years when you're in lower AGI levels to drop you out of a certain tax brackets. There's 3 capital gains brackets, the 20, the 15, and 0. The objective of this type of planning is to drop you out of the 20 into the 15. Yes, sometimes even to the 0 if you have no other income. For a married couple, the first 90,000 a year of capital gains is taxless. Okay. So we capture that sometimes. There's another tax called the net investment tax, another 3.8% tax on top of that above 250,000 in AGI. So a couple of thoughts. The first thing is to recognize what their AGI, their other income sources are. We're going to sell and recognize income annually to drop them below certain amounts that'll keep them at the 15 and even capture some of the 0. And even get rid of some of the net investment tax, at least capture another 250 exemption every year, but yet sell today, defer tax in the future into smaller increments. Now you might say, Jeremy, dropping from the 20 to the 15 doesn't sound like that big a difference. That 5% difference is 25% of the tax. At another 3.8 net invest, you're talking about 30 to 35% savings in the tax potentially. And yes, there's a particular technique to be able to do that. Diversify today, sell, not recognize a big tax bill, recognize a little bit every year into the future so that you're dropping the lower tax brackets, saving 25 to 30% of the tax, but diversify today.
I love it. These are the types of things you mentioned right at the open, that tax laws change, and there's so much that has changed. And one of those things that gets undervalued, and you mentioned this as well, is life insurance. And there's really 3 Ps that people talk about. We often say you can leave money to the first one, people that you love. The second one is places you love. The third one is politicians you may not love. And so, there is a lot of complexity with what you've already talked about. And that's why we love bringing you in, as you make the complex simple. But you even mentioned not everybody needs life insurance, but why can life insurance be a tool that can really help people as well in some situations?
If you thought of life insurance as an income replacement, you don't really need it for that purpose anymore. So the word need now is replaced with an outcome, right? So a lot of our clients who are, between 2 and 6 million or even higher than that, they are invested in equities. Even though if we ran a financial plan on them today, we could show them living off fixed income for the rest of their life and being just fine. But yet they're in equities. Why? Not because they need to, as I just pointed out, they'll be fine. It's because it produces an outcome that otherwise isn't possible. And so that is true of life insurance as well. They don't need the life insurance, but when we look at it, it produces outcomes that aren't possible. What are some of those outcomes? One of them is tax diversification. So obviously it's going to be tax-free. Anytime tax rates would go up, that makes it more valuable as a class of assets, just like a Roth would be suddenly more valuable. So that's one reason. The second reason is, a lot of people they want to pass on money to their kids. They're not sure when they'll be ready to, or they don't want to maybe mess up the decisions they might have otherwise made had they not had access to the money earlier, right? So it allows you to put money away on a tax deferred basis and eventually tax free through loans or withdrawals later on, and not make that decision as to whether you're unintentionally, changing the way your children would have otherwise developed, right? So you might have that in trust, or you kick that can down the road. You're just setting money outside of your estate for that later eventuality when you are ready. The only decision you're making at that point is basically to save on some taxes. And when you're ready emotionally, and the kids are, you feel both of you are, to actually release some of that to them during their lifetime or at death. And frankly, a lot of this money would never have been spent. I mean, I don't know about you, but I don't see a lot of clients coming to us with 5 million or more failing a retirement plan. There are people who would. They don't come to financial advisors because they're spending like liverati. You know what we would say, right? But mostly the people come to us, there's 2 characteristics I'd say almost all of them have. They're delegators and collaborators as a character type. And they're very responsible people. They have really good character. And so if somebody's out here listening to that and that fits you, might be worth a meeting.
We've helped thousands of families prepare and plan for their retirement, and we can confidently say this from experience. It doesn't really matter how much you've saved for retirement. It's what you do with the money that really matters. If you've saved $1 million for retirement, for example, a comprehensive plan for your money could make 1 million act like 2 million. But it could go in the opposite direction too. If you don't have a plan, you could have 2 million work like it was just 1 million. That's the kind of impact a comprehensive financial game plan could have with your retirement savings. Let's make sure you have the best retirement plan for your unique situation. It all starts with a free customized B.O.S.S retirement blueprint. This process could help you save tens of thousands, if not hundreds of thousands of dollars in taxes in retirement. Also, discover the strategies for wringing every nickel out of your Social Security benefits, plus so much more. It's easy to get started with your free B.O.S.S retirement blueprint. Just check out the description for this episode where it says, get your free B.O.S.S retirement blueprint. You can text, click, or call 800-769-7550 and connect with a member of our team. It's right there in the description. A text, a call, or a click is all it takes to get started with your free B.O.S.S retirement blueprint.
You bring up this of the three solutions that you talked about on minimizing tax in tax deferred accounts. You talked about Roth conversion and you talked about life insurance. If someone was stuck trying to decide between which option is going to be best, how would you approach that scenario in helping them? We believe in the principle of good information to good people helps them make great decisions. How do you talk about how we approach that as a team and helping that make that decision between, do we use Roth conversion, going to life insurance, or maybe a little bit of both?
Yeah. Well, first thing, it starts with just a good conversation. I mean, I think a lot of people assume that tax rates will be high in the future. I think you could see how that could happen, especially for a certain class of people, higher net worth for social reasons, equalization, et cetera, et cetera. There are scenarios that a lot of people haven't considered where they actually could be lower too. So those kind of conversations, just good conversations. It's not a political conversation. But sometimes they're founded in something like that. It's about the way the monetary system works. A little bit about that, a little intellectual. If people like those kind of conversations, they don't, we don't. But the other thing is that when you're measuring, so some people also they lean one way or another, but they just need data. They just like it, right? Mm-hmm. We can help with that. We have all sorts of, what you want to call them, calculators, where we measure that. A lot of times it's based on some assumptions. And one of the assumptions is our tax rates can be higher. Also, the time we're going to measure. Life insurance will eventually be defeated if you go long enough because the death benefit is usually fixed. So if somebody wants to go to the age of 100, eventually some investment over time will overtake it. But the question isn't one or the other oftentimes. Ryan, I think that the reality is that there's a mix of things we can do to capture a couple different opportunities. So, but the data, some people just need data, and we certainly can help them with that. So they feel like they've done their homework. And we oftentimes do that too. Hey, we're very, very responsible people ourselves. So a lot of times we've already looked at this multitudes of ways. Independent of the person we're sitting across from, we've looked at this for other people, right? So we kind of know the gist of the parameters of when it will work and when it won't. And we can tell them that without having to run the numbers, but it's good to show them that, obviously.
The proof is in the pudding, right? When they can see it in black and white, it's not just a matter about the emotion, it's about the dollars and cents. Mm-hmm. And so that's one of the reasons why we love to bring you in on these cases. Let's talk a little bit more about maybe an example. First off, somebody who may be listening, they may be 55 and they're thinking about this, maybe 60 years old, they're starting to think about this. They think, hey, maybe it would be a good time. Or maybe somebody's retired on the other end and they're like, is this too late for me? Could you walk through an example? First off, when is the best time to have somebody to talk about this? And then secondly, what does it look like when our team and you sit down with somebody, not only just to go through it, but maybe just even give it a concrete example you've recently been through?
Sure. A recent one where you're talking about, where I'll give you a really good example. There's a business owner out of Wisconsin this late last year, three owners of a business, HVAC company actually. So kind of a blue collar business, but the person that initiated a conversation with us was a prospective client, and he was trying to get out of the business. He was 10 years older than the other two partners. Basically, he wanted a way to save on taxes, but also to get the other two partners to initiate a buyout of him. So unfortunately, in their agreement, there was no stipulation that they had to. So one of the things you mentioned is, when's a good time? I think the time to, if you have the kind of net worth we're talking about, just to explore what's possible. You may think, I don't need to do anything right now. I'm not going to retire tomorrow necessarily. So, but the reality is, when you think you need something or want to do something, is actually usually a pretty poor time to actually go get that help. You limit some of your options. And the example I gave of the HVAC company, the owner was 10 years old, wanted to get out, but because there was no stipulation, and prior to that, he wasn't thinking of leaving, so he didn't think to go look at his operating agreement. And that's basically where it would stipulate what's supposed to happen under certain triggers. So now he wanted this trigger to happen, but they had no agreement. So guess who's over the barrel? The person that wants something is usually the one that's, kind of is frankly the one that's going to have to give up more. You mentioned some of the concentrated stock position earlier, like an executive that had stock. We can help people with real estate, business interests, or stock. Doesn't matter what it is that they might be exiting. If you're over age, usually you're over age 50 when you have accumulated that kind of wealth, right? But if you're sitting on an asset that's got a fair amount of gain in it, doesn't have to be stock, could be real estate or business interest. The same or similar techniques, actually there's more options for real estate and business interest than even stock. We can help do the same thing, where we drop you out of the 20, you're subject to the same tax brackets, same AGI limits. We would have more options for tools to use without getting into the weeds on that right now, but we can help you achieve similar results as I just mentioned earlier, as in the concentrated stock position, where it could save you 25 to 30%. That is the goal, getting out of the 20 into the 15. Help you create a replacement income, because if it's an asset that's producing income like real estate or a business, you're going to need to do that. And that's exactly what Ryan and Tyson's firm does.
I love that. Jeremy, let's talk a little bit about time is of the essence here. At the time we're recording this, it is fall of 2024. We do have some tax cuts that we know have an expiration date on them. And one of the things that I appreciated about what you said earlier is we don't make this political. Oftentimes these tax cuts that are expiring are called the Trump tax cuts to many people. The 2017 Jobs Act. But we also have other tax deadlines that are coming up all the time. There's all these things with estate tax planning and different issues. But let me just focus in on this one that we know is expiring, which is as of December 31st, 2025, there is a change that's going to expire in the tax code, which means taxes are going up if nothing is done before then. Let's talk a little bit about, this is not political. It's just good thinking and planning. How do you approach these upcoming tax deadlines in your mind when you think about this? For all of the clients that we meet with, what goes through your mind, Jeremy?
Well, first thought is, I think to clarify for most people, you listen to the media and you hear a lot of different things about who these tax cuts helped. I can tell you definitively, looked at these numbers. I have a spreadsheet built out with all the brackets from 2020. I did it last year, 2023 to 2026, and the changes. The biggest tax cuts were in the 15 to 22 and the 24% brackets. They're going to go up by like 20 some percent, so I guess where I'm going with that is, when I do the math on it, I look at, and I can plug in the different incomes. So if you're below 700,000, you're on average, you're looking at a 15% tax increase. If you're below 100,000, you're looking at like a 19% tax increase. So it really did help people less than 100,000 most. If you made over 700,000, your tax increase is like 6-7%, which tells you right there that the tax didn't help people above 700,000 that much, right? So where I'm going with that is, if you're sitting on something that's highly appreciated and you're thinking tax rates are actually going to happen like that, I do have a hard time believing they're going to let that. It doesn't matter what party is, who's going to let taxes go up by 15% on people less than 400,000, right? So I'm going with that is, I hope they'll do something before that. I don't know that, so it's not a political statement. I would think that any party would want not to have taxes across the board, especially for people under 100,000 going up by almost 19%. So we'll see if that actually, if a fix doesn't get made, even if it is a short term for a year, it appears the tax rates go up, that they can retroactively fix it in 2026. So I'm hoping that happens. Who knows? But I would say this: if you're worried about that, yeah, there's some things you can do. Even right now, if you were thinking about selling something right now, maybe go see Ryan and Tyson and at B.O.S.S, Retirement Solutions, and just consider the simplest thing might be is do something as simple as, if you're selling like $1 million piece of property, sell some in November, get the other check, and it's considered an installment sale in January 1st. 2 calendar years, you might drop a little certain AGI level. For a married couple, that's 590 before I hit the 20%. What I just said, and you're at 200, that means you have 390 this year and 390 you can get next year, and keep below the 20% cap gains rate. That saves 25% on the tax. There are some simple things what I'm trying to say. We would just, in other words, it's not just about the techniques, and you mentioned complexity or advanced stuff. I look at it like this: it's no more complex, or some of the things I cover aren't any more complex than IRA rules, which are pretty vast sometimes, that most people are familiar with IRAs. It's just that I do this day in, day out, right? So a lot of things we help people do is execute on things that otherwise would be very complex because it's not done regularly by even the professionals they know. And another standard of care that we have at B.O.S.S is that if you are at that net worth, about 2.5 million plus, what we call high net worth planning, the standard of care is that we will bring in subject matter expertise like myself, which is a standard of care that most other places probably don't have or guarantee. I worked at Wells Fargo, for example. At Wells Fargo, we didn't bring in somebody like myself till we got to 20 million plus. So I think that standard of care, skill, expertise, and frankly, wisdom being brought into bear at 2.5 million to up to 20 and then some. I think that's a standard of care that doesn't exist in a lot of places.
Yeah, I love that you bring that up, because what we really feel like is that we always want to bring more value to our clients that we serve, and potential clients that we serve. Speaking of value, just one last question. One of the things that we talk about is getting more with B.O.S.S. What's your get more with B.O.S.S number? And a lot of times people get so fixated on what some fee is that they forget about that value on the other side of the equation. So when we're talking about tax mitigation, when we're talking about helping somebody ease into retirement, can you speak to that for just a minute or so?
Yeah, I think it's fair for somebody to, sometimes we work with people who have been doing things themselves for a long time. The question is, am I getting enough value? So I think that's fair. In the first meeting, usually with a client, or a prospective client, we are trying to understand their situation first. But we should be able to conclude that meeting with letting them know things we already see. So they should be somewhat excited for the second meeting. If we're good at what we do, we're not on a fishing expedition. We've done this before. We know the ways we can help. So in the second meeting, usually where we are, we're not trying to show our hand to say, this is the plan, either like it or not, right? As I said, it's not about need for a lot of these people. So really what it is, we're probably showing you several options as a prospective client. And in there, the real decision we're asking you to make or consider is a relationship. We would have discussed several options. You'll gravitate as a prospective client to one or more of those, and we'll spend more time focusing on that if ultimately you decide that you want a relationship with us. That's what we're trying to show, that we can in fact definitively help you, not just help you, right? That the value is not, it's not a matter of, can we help? We certainly should be able to demonstrate that. If we are able to, then the second question would be what does that cost, or what do we want? Sometimes people have, 2 or 3 million or more than that they've been managing, and they wanted to manage some of them themselves. So the question is, how much would we manage? That's something that's definitely negotiable, obviously. And it's on a case by case basis, but generally the fee is a fee structure that's in place, that we already know has brought value to other people. As I said, we've done this before. So, delegators and collaborators, the question I'd have for anybody that has done things themselves is that they too should be prepared for that second meeting to ask themselves, at what point would it take, for you emotionally to be ready to collaborate? These people that we work with are no less intelligent than people that do it yourself. In fact, many of them, I would say, are more so. They've come to their point in their life where they understand the wisdom in that, in having subject matter expertise brought to bear on their situation, and that is, in fact, was worth it, right?
Love it. Well, thank you so much, Jeremy. This has been fantastic. For those of you who are listening, we appreciate you spending the time. As you can see here at B.O.S.S Retirement Solutions and Advisors, it's not just about a financial product. It's about a plan. A plan will always beat a product anytime. Thanks so much for joining us today as we look at this scenario. We know it's getting close to the end of the year. If you've got some questions on your mind, we just invite you to come in, visit with us. We'll link in Jeremy with our team of advisors, along with the other experts that we have in all of the different areas that will affect your B.O.S.S retirement blueprint. Thanks so much for joining us today. We look forward to seeing you in our offices soon. Have a great day. And remember this, retiring successfully, it doesn't happen by accident. It starts with a plan, and that plan is the B.O.S.S retirement blueprint. Thanks, everyone. Have a great day.
Thanks for listening to the Retirement Solutions Podcast with Tyson Thacker and Ryan Thacker. If today's episode inspired you to plan for retirement, go to bossretirement.com/podcast to receive a complimentary B.O.S.S retirement blueprint. We'll be back in 2 weeks with another story to help you retire with confidence. B.O.S.S Retirement Solutions is an independent financial services firm helping individuals create retirement strategies using a variety of investment and insurance products to custom suit their needs and objectives. Investment advisory services are offered by duly registered individuals through B.O.S.S Retirement Advisors, B.O.S., an SEC-registered investment advisory firm. The information contained in this podcast is given for informational purposes only, and no statement contained herein shall constitute tax, legal, or investment advice. The information is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. You should seek advice on legal and tax questions from an independent attorney or tax advisor. Our firm is not affiliated with the U.S. government or any governmental agency.